Welcome to the Money Study Podcast with Jim Bishopp. In this podcast, we bring lessons on personal finance to life, helping you achieve the dignified retirement you deserve. Jim will guide you through practical financial strategies and tips to manage your money during your working life and through retirement. Now, on to the show.
Hello and welcome to the Money Study with Jim Bishopp. Jim, what's going on today?
Living the dream, pal. How are you, man?
I'm here to learn. I mean, I'm been waiting for your tutelage.
Well, right. Yeah, I know. I appreciate it, Eric, but I'm not sure I completely buy that, but I appreciate your saying, man.
All right. So what are we talking about today?
So today, I think we should talk about staying the course, right? In the last couple of episodes, we talk about why taking some risk might make sense. And just as a really short recap, most of the folks who tune in here are either are on some sort of pension, right? The state retirement system, civil service pension, public safety retirement pension, and all those things have no market risk attached to them. Right. So they're a true pension. They're going to provide income in retirement, but you are not bearing, the participant is not bearing the direct risk. They're also generally, not always, Social Security participants. And again, they don't take any risk there. So that's why taking some risk, which we covered in the first session, might make some sense. The second session in this series, we talked about asset allocation, how to mix money, diversify, spread your bets a little bit. And so today, I think we should talk about staying the course when the markets turn against you.
Okay. And I like the fact that you've called this an investment basics series, but at the same time, you're getting into some meat, which is nice. I mean, it's when I think of investment basics, it's invest. Put your money in something, a 401k, blah, blah, blah.
Right.
But you're really diving into some things in this series. So I really appreciate it. And so we're talking about staying the course. I'm assuming that we're talking about staying the course when it's good and when it's bad, right? So volatility and when there's things are looking really good. We know that markets take downturns, right?
Yep.
So let's start there. How do we handle that when we see the market doing something funky?
Yeah. So first, I think it's really important to think about that asset allocation model or those spreading your bets. So I don't like the term asset allocation because I think it's a little bit of investment gibberish, right? But in the second session, we try to define that a little bit, spreading your bets amongst different kinds of investments with varying degrees of risk. So the overall portfolio has a risk measure that you're comfortable with. So when the markets turn down, really important that we trust that model that we built, and we trust that it doesn't have more risk than we can tolerate in a downturn, because we know markets are going to turn down. Fact of life, they are going to do that. If you can't stomach that, you need to tell your advisor, and we make some different pivots. But if you're going to have any money in the market, it's going to turn down. I guess in conjunction with that, remember that it's not an all or nothing proposition, right? We think about that risk as a continuum, right? On one end, we have things that are really, really aggressive, stocks, what have you, and some things that may be really conservative, right? And so we can be anywhere on that sort of, risk scale that we want to be, closer to the conservative side, closer to the aggressive side. So it's important that when we built that model, we trust that model, and that model is built on that scale where we're comfortable.
So in trusting that model, you're telling me, well, it sounds like you're telling me that as the market drops, we don't want to sell, right? Because I think that's a lot of people's first reaction, Jim, is that they're like, I got to get out of here, right?
Yeah, we hope not for our clients, because we've talked to them long and hard about how much risk there is and what to expect when that happens. But I will say that you're right. It's, it's really, I don't want to say impossible. Maybe somebody has a black box or a mechanism that will, predict the direction of the market, but we don't. And I've looked at a lot of people who've tried, and it's not very successful. If you think about it, Eric, when is the bottom in a market? How do you know when that bottom is? And how do you know where the top is? So if I want to try to buy or sell, I got to know where the bottom and the top are. And that's just really, really hard to find. So I think it's really important that we build that model, we trust that model. And then when the markets turn down, and we know they will, we don't panic. Yeah.
And what I'm hearing you say is that it's almost impossible to time the market, right? That's what truly it's almost like gambling, right? I'm taking my best guess at what's going on now. So I'm going to buy or I'm going to sell. And if it's a guess, then, it's like putting on 33 black, right? You spin that wheel.
Well, we're Irish, so we always say don't bet against the hare, right? So we go bet on red. But no, that's right. We've watched the best people in the world try. I'll give you an example. In 2008, people would say to me, I would say, listen, we built a model. You should stay the course. This will change. But in the midst of that downturn, what they hear is you don't have a good solution for when to get out of the market or to get back in, which is absolutely true.
Yeah.
And when I say you should just stay the course and ride it out, they really want to climb across the desk and punch me in the face, But the truth is, I can't predict those movements, and nor Can anybody with any accuracy that I know?
Yeah. And it sounds like you need some hazard pay is what it sounds like to me with that kind of situation. So what other examples do you have? I mean, you talked a little bit about the 08-09 downturn. Recently, right? The pandemic.
The pandemic, right? I literally had people calling me, Eric, that would say things like, this thing is not going to turn around in my lifetime. Well, I guess unless your lifetime ended in 6 or 8 months, it did turn around and you were just wrong. It feels like that, but we're bumping up against all-time highs. 2008, that was a longer, more protracted downturn, really trying. But again, we're bumping up against all-time highs in the markets, depending on how we gauge it. But we're at really high numbers in the stock and bond markets. Same with 2000. We saw the tech wreck, we saw the housing bubble, now we saw the pandemic. We're going to go through those things, but we've always recovered from those. I guess that's not to say that a meteor couldn't hit the earth and we wouldn't recover, but if history is our teacher, we have recovered. And so not panicking down those stretches has made a big difference. I'll also add, when you hear people say, I never recovered from the downturn in the market, what they probably did was, they sold as the market went down. They put their money in something really, really conservative, like a money market or a savings account, or made almost no interest.
Yeah.
And they just didn't participate in any of the recovery. Because again, it's hard to know. By the way, that same person calls me up now and says, boy, the market looks really good and I'd like to put my money back in. Well, what they really are doing is looking in the rearview mirror and saying, the market has looked really good in the last few months and now I want back in. And usually they're just in time to get their butts kicked again.
I would assume, this is just me assuming, but I'm assuming because of your conversations and the conversations we've had before, that your clients are not like mostly in the stock market. They're not like 90, 100% in there.
I think that's really determined by a couple of things. Age. So we have some 25 or 30-year-olds who are beginning their investment career and have a lot of time to weather market conditions. We hope that more risk rewards them over time, but it will clearly give them more volatility as well, right? So the lowers are going to be lower, but we hope the average rate of return over 20 or 30 years is better than if we were more conservative. To your point, though, most of my clients are a little older. They're either pre-retirees or moving into retirement. And so those folks definitely are, somewhere more towards the conservative side of that, scale or continuum, more on the conservative side, just because they don't want to or can't stomach that volatility down the road.
Yeah. So again, I think I'm speaking for the entire audience here. What can we do, right? We know that if the market bottoms out or goes down extreme, we don't want to sell out. But is there something that we can do at that point to help protect ourselves, help make it better?
Sure. So we've all heard the terminology buy low, sell high. I will tell you right now, that's one of the most counterintuitive things you'll ever do in your entire life, right? It's like saying, I'm going to go to the racetrack and I'm going to bet on the horse that just lost the last 6 races. Where else do you bet on losers? But in buying low, that's really what I'm telling you to do, right? Buy assets that have decreased in value. And to do that, maybe we have to sell one of those winners that's done really well, because we know all of these kinds of assets are cyclical in nature. Some go up, some go down. And so we can sort of lean in or out of sectors that we think are better, and maybe even just rebalance back to that model. So imagine we were 60% bonds to start and we were 40% stock. Well, the bond values have gone up a little bit. The stock values have gone down a little bit. If we just rebalance to that 60-40 model, we're forced to sell some of those bonds that have done well and buy some of those stocks at that lower price, thereby taking advantage of that drop in value. So rebalancing is a great strategy there too. But leaning in can be helpful, but timing the market is, again, I don't want to say it can never be done, but I've not seen anybody do it really very well consistently.
Yeah.
Hope that helps.
I believe it's Warren Buffett that said, he likes to buy things on sale. Right?
Yeah. Well, Warren Buffett also said, my favorite out of Warren Buffett is rule number 1 is don't lose money. Rule number 2 is see rule number 1. So yeah, but yeah, he buys things on sale and he's got the guts to do it and the wherewithal, and he goes and does it. He buys things that are down in value that he thinks will recover.
Yeah. Absolutely. But I think for the average person, I'm not Warren and I don't know him personally, even though he lives near me.
Yeah.
I would assume that it's incredibly difficult to be able to do that, to buy low, sell high.
The other thing about Warren is he has enough money that he'll never need it to live on. You and I are investing our retirement assets, right? If he loses $100 million, I'm making that up. He can lose a lot of money and not affect his lifestyle. Most of us go out and lose 25 or 30% of our value. Our lifestyle changes in some way. And so he has the capital to make that change. I'll give you one other thing about Warren that's really interesting. He bought his first stock when he was, I think, 16 or 17 years old. I don't know how old he is now, but I think he's in his 80s.
Yeah.
So the biggest trick to his wealth, in my view, and things I've read is just time in the market, right? I mean, he's had 65 years of market experience. Even with average growth rates, even without being a spectacular investor, he's amassed a great amount of wealth.
Yeah.
So time in the market is really important as well.
Yeah. Time in the market, not timing the market.
That's exactly right.
Big difference there.
Yeah, no, that's exactly right. So the longer you have to be in the market, the more. This is going back to one of the last sessions. I don't remember which one, but we talk about the three things that are most important in building a model, right? The first one is how long you have in the market. So as we talked about earlier today, if you're 30 years old, I can take a little more risk because you're not going to, assuming this is retirement money, you're not going to need the money for 30 years. So if we lose in year 10, 20% of your value, history proves that's not a terrible situation, right?
Yeah.
If you're 55 and we lose 30% of your value and you need your money when you're 60, that's a whole different ballgame.
Yeah.
Right? So time is the number one factor. Number two factor is how well you sleep at night. I say my job is to make you as much money as I can without taking more risk than you can stomach. And then the third one, and by far the least important, is what you or I think is happening in the economy and the market. And because it's just so hard to predict.
Yeah, absolutely. All right. Anything else for today's podcast? I know this was a quick one. It is
a little short.
It hit hard, hit fast, which is good. I mean, because it is a basic, right? But it's something that we all need to be reminded about.
Yeah.
So how do we wrap this up?
I guess one other point I'd make, and we'll make it a little further next time when we talk about, the news, is just making sure you keep your head down and you don't get influenced by the news because, they're selling terror, right? I mean, their words are, if it bleeds, it leads, right? I think that's a, saying in the news media. So you just have to build that model, know that the market's going to go down, stay the course when it does, and don't panic and try to just keep your head down and get to that end game. So
yeah,
hope that helps.
Absolutely.
It is short, but I hope it helps.
Well, no, and I think it does. And I think it's one of the best things that you said is that you want to be able to sleep at night. So I think it's up to each individual client to be able to, or each listener at this point, to be able to say, hey, what am I able to stomach? Like you said, what am I able to stomach risk-wise? I need to be able to sleep at night so I can work hard the next day to continue to build that retirement. Because if you're not sleeping, you're not working well, you're not going to build that wealth. I mean, it's a whole cycle, right?
I'll give you a story about that. So when I was younger, I bought $750,000 worth of real estate. I didn't have any money. I borrowed most of it to buy it. And it was a great investment. I knew it was a great investment, but I laid in bed and watched the ceiling fan go around in circles for 2 weeks. I'm like, this is ridiculous. So I sold it. Man. And because I just that was more risk than I could stomach. So you have to be honest with yourself about how much risk you can really stomach and how well you're going to sleep at night based on that.
Yeah, absolutely. Well, I'm thinking to the listener out, if they're sitting there thinking, I don't know what my risk is. I kind of know what my risk tolerance is, but I'm not sure where my risk level is right now. And they want to reach out and talk to you about it. How do they get a hold of you, Jim?
Yeah, so I think Eric, I've done a poor job of that in the last few podcasts, but they can reach us through our website, which is www.sji.us.com. That's S like Sam, J like Julia, I like India, .us.com. My email is the same at sji.us.com, but it's jbishop, Bishopp, or on our phone number. So I'll give you the 800 number, 800-754-6133. So any of those will work, and we'll get you the right resources.
Fantastic. Jim, thank you so much for the time today.
Yep. Eric, appreciate it, bud.
You bet. And of course, our last thank you goes to you, the listening audience. Thank you so much for tuning in and listening to the Money Study with Jim Bishopp. If you have not subscribed to the podcast yet, please click the subscribe now button below. This makes it much easier to share these podcasts with your family. And also, it'll give you a little alert when he comes out with a new episode. Again, thank you so much for listening today. For everyone at SJI Financial Services Incorporated, this is Eric Johnson reminding you to live your best day every day. And we'll see you next time.
Thank you for listening to the Money Study Podcast. Click the subscribe button below to be notified when new episodes become available. The opinions expressed in this podcast are those of the speaker and/or the guest and may not necessarily reflect those held by Voya Financial Advisors. Comments concerning the past performance of monetary instruments, investment indexes, or international markets are not intended to be forward-looking and should not be viewed as an indication of future results. Investment advisor representative and registered representative of and securities and investment advisory services offered through Voya Financial Advisors, Inc., member SIPC. SJI Financial is not a subsidiary of nor controlled by Voya Financial Advisors.
Using diversification asset allocation as part of your investment strategy neither assures nor guarantees better performance and cannot protect against loss in declining markets. Investments are not guaranteed and are subject to investment risk, including the possible loss of principal. The investment return and principal value of the security will fluctuate so that when redeemed may be worth more or less than the original investment. Generally, the greater an investment's possible reward over time, the greater its level of price volatility or risk.